GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you.
Everybody hangs off every breath and every word of Janet Yellen and the U.S. Fed. Now, on Wednesday, 3 of the governors on the Fed said they would be in favor of higher interest rates, but nothing happened. How much does their chat influence the stock market?
Well, actually, there was a study came out a number of months ago, and, of course, writing a market letter aimed for Thursday publication, and when Wednesday comes along and these Fed utterances, which are intended to drive financial markets up, is a little bit of a distraction for a letter writer such as myself. So anyways, I recalled this study of a few months ago. It was originally done by the Ned Davis Research, which is a big outfit in the States. So they just took the S&P of over 20 years and ran it without the 2 trading days associated with a Fed announcement. And the latest peak in the S&P would have been not as high as in 2007. But if you put the index, as it is, the real index, or the index with the 2 days, it's double from where it would be without those exciting days of Fed announcements. So it really is an interesting variation on modern portfolio theory. And so you get there and you're looking, say, I'm all right as a trader, and anybody who's a trader, hey, you go from overbought to oversold. But if you're an investor, and they always emphasize the long-term hold, and the gain that you're looking at is based upon 2 days, trading days, every once in a while with Fed utterances. I mean, it's really pretty scary. What happens if, as you point out, 3 of the FOMC committee people are suggesting the Fed rate should be increased? But our view on that and the history of it is that, and the Bank Act in England was revised in the 1840s, and then after that, the Bank of England, which was the senior central bank, was able to raise interest rates above 5.5% in a period when interest rates were going up. And the simple part of it is that interest rate changes in going into one of these big booms and then out of it, the senior central bank is 4 or 5 months behind the change in market rates. And so this sets up a certain irony when many pundits in the street in New York and London then are all looking and guessing and arguing and wasting time thinking that the Fed rate is going to be very important on the overall condition of the market. And yet the Fed is following. So here you can take a look at, we used to look at decades ago, the call money, which was the overnight money for loans to brokers, and then nobody follows that anymore. And LIBOR is a good rate to follow, the London interbank rate. Also, there's HIBOR in Hong Kong, which is the Chinese interbank lending rate. So, and these have been going up lately. So we got on to the LIBOR in July and noticed what it did in 2000 and what it did in 2007, and it it led the general change in the credit markets that pushed off the contractions. So we're watching this now, and even more recently, like the start of the year, in December, January, where it was a virtual bloodbath in the financial markets, and it was preceded in November by a sharp rise in LIBOR. We've been following the 3 months, and so what we have now is it's getting to be up about 15 basis points, which is now becoming fascinating, but it hasn't been as sharp a rise as in November. So perhaps somewhere in the next few weeks, this looks like a good trend. It was actually 0.867 on Monday, Tuesday kind of thing, and then with the great excitement from the Fed that they were not going to change rates, and many rates declined. This one declined, 7/100ths down to 0.86, so not much setback there. But so anyways, with this one, you have a movement on that has preceded sell-offs. And the other thing that's fascinating now is that, of course, in order to appear non-political, the Fed is not going to raise an administered rate until the election's over. So I wouldn't, it's just, you'd sort of watch the Fed because it's in somewhere between a crock and a hard place. But one, as a serious trader, would be watching LIBOR to see where that goes, and the trend is up, but it's a slow trend. Last November's move was a fast one, and that really pushed off some liquidity problems. So that's our fascination for the next few weeks.
So what you're saying is that really the real interest rates are set by what happens with the overnight rates in London.
Yeah, like it used to be in way back, the Treasury bill rate. For example, interest rates go up in a boom and then down in a bust. And Treasury bill rates in 1929 went up until that April, May, and then headed down. And then, of course, in August of 1929, the Federal Reserve raised their discount rate from 5 to 6%. I don't know why it did that, but it was all part of a package. The idea was, that's right. The idea was to tighten up money to Wall Street because they were getting worried about the amount of speculation. At the same time, they did some measures to ease money for Main Street, and that was the full intention. So the Fed really didn't tighten up, but the problem is that the money markets were exhausted and changing, and then you had the collapse in speculation. But what gave an early warning, if one was a researcher or an investor or a trader in 1929 and had looked at the pattern on the previous bubble of 1873, one would know that when the Treasury bill rate starts down, watch out. But so the T-bill rate started down in May, June, and then the Fed lowered its rate in that October, and the rate went down to effectively zero, as did the T-bill rate in the 1930s with the Depression. So this is always ironical because, far too many people in the investment world really believe that the Fed sets interest rates. Now, that's on money market stuff, like stuff shorter than a year maturity. But what you have going on out here is that all the central bankers have been buying long bonds, and hitherto they didn't really make much effort. The thoughts were that manipulation on short rates would effectively get the economy going or whatever their objective was. But this time they've gone out and they have bought the bond market, and they bought equities, and which is buying at exceptionally high prices, and it's very much of a crowd thing. It's like, hey, come on in, guys. All the lemmings are doing it. So it's going to be interesting to see how it goes. But I think that a market rate of interest such as LIBOR has turned up, and in the past, this is a warning. You've had a couple of setbacks in long-dated, lower-grade stuff, which also is a warning, but nothing dramatic on the price of junk bonds or the spread of junk bonds to treasuries. Let's put it this way: the credit spreads, which were smashed all to hell in the convulsion down into January, February, the narrowing of credit spreads has been outstanding, absolutely outstanding. But there's been no narrowing in 3 weeks, so who knows when it could change. But the argument we've been putting forth is that the Fed, when a credit market's due for a change, the Fed has no record of ever preventing that change. And the change would be the yield curve, which has already made a change. The one that is not yet changed is credit spreads. And then the other one, which is real long interest rates, where you take the long rate and divide it by the consumer price index, and that gives you the real interest rates. And it is, it's come down, but it looks like it's basing and looking to go up. And so this one, all of this could become effective, somewhere in the next 4 or 5 weeks. I think we're going to have a very interesting fall.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, you're saying some sectors became overexcited over the summer. What were they?
Yeah, we were watching that. You remember we had our big rotation in January into then beat up commodities and commodity sectors. So you had a terrific rally for crude oil. Base metals were outstanding. The base metal mining stocks did fabulously well. And of course the sector that did, let's use a term like this, most well, were the golds. So in basically July, you saw technical excesses were reached on the rallies with the base metal miners. That's the EMX, absolutely outstanding rally, and triggered off upside exhaustions, which is a momentum run thing, and then also it triggered off sequential sell, which is a pattern thing. So when you get those two together, it's usually pretty good. So they've come off a fair amount. The other sector that was very excited was the utility index, XLU, and that one generated those signals as well. We also, in July, because utilities were flying with the long-dated treasuries, and we had technical excesses on those as well, and they've sold off. The other one was the precious metal stocks, and they were up there. They were the best performing group by far. And upside exhaustions and the sequential sell. So that was, I think, late July, and the advice was that this would be the most significant correction in the gold sector since the bull market began in January, and we've been calling that a cyclical bull market. So this would be the most significant correction. And when we put the numbers to it, it looked like the gold stocks could decline 20% plus. Well, we're getting close to 20% now. The other thing was the timing target for late September. So this is where we then start to look for, in this case, bottoming action. But we're not oversold enough yet. And so the view is that the gold and silver stocks have further to decline, and it would probably end with an emotional sell-off. Now, the other part that's worrisome to the precious metal sector, of course, is the dollar index, and it's trading either side of a moving average. So we call it basing and preparing for a rally, and it sort of looks a bit like June of 2014, where boom, you got that big rally and you had the whole collapse of crude oil and stuff like that. So the dollar index is preparing for a rally, and that would be probably based on a liquidity problem coming into the financial markets. It's the way it's worked before. So this then gets us back to this Federal Reserve again. And, of course, their objective is to depreciate the currency, and the financial markets are not, the currency markets are not cooperating on that side. But, you know, there's some irony out there, Jim, because at the moment, the Federal Reserve is desperate because the old tools such as easing money to prompt economic activity not been working. So then now they're being a little more honest with this now. They're driving up bond and stock prices so that wealth effect will boost the economy. But it's not really happening. So they're just strictly on trying to hold the whole thing together, stocks and bonds up. So if this goes adverse, and it can do that, the central banks are going to be very embarrassed to see that their whole promotion of stocks and bonds isn't working. So maybe they might lose a lot of the admiration that for some reason or other continues on. So actually, when you look at it, the next contraction, which, considering how extreme speculation has been in the bond market and in the stock market. Also, we should mention in the real estate markets there that that's another asset they need to have going up to keep the party going. And in London and in New York and Manhattan, high-end stuff has been faltering now for some months. And then another marker, of course, is art. And I saw an article just a couple of days ago that art markets are suddenly become kind of precarious. So the point on the Federal Reserve and other central bankers bringing prosperity through rising asset prices is that in order to get their portion of a credit expansion out, they really need speculators in a rising asset game borrowing money. But if asset prices are not going up, then the amount of borrowing diminishes, and then if the prices start to fall, then you get Mr. Margin in there. So here's the irony, is that the Federal Reserve is desperately trying to get speculators even more leverage than they have been, and in the trade we call it getting the accounts out of line. And of course, every brokerage firm has a team of margin clerks, and we often just refer to him as Mr. Margin. And his job description is vastly different than the job description of your basic central banker. Mr. Margin's job description is to get the accounts in line, and that's what he will do as asset prices come down. And this is, you look at the Federal Reserve, started in 1913, and the intention was to prevent financial setbacks that precede recessions. There's been 19 recessions since. So here we are. This time they're long stocks and bonds. Will Mr. Margin be knocking on the door of the Federal Reserve? Maybe in a month or so we can answer that question.
Bob, thank you so much for chatting with us.
Hey, Jim, always fun. Good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show and for Bob can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.